Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tamboran Resources Corporation quarterly report. Tamboran Resources Corporation is a natural gas company that specializes in developing unconventional gas resources in the Northern Territory of Australia. The company's assets include various exploration permits, EPS, located in the Beetaloo Basin, which provide a significant foundation for its operations. The company's portfolio includes a range of business and service activities, including exploration and development of natural gas resources, management of working interests in various EPS operation of 100% owned assets, such as EP.A. 197. Tamboran Resources Corporation has established itself as a key player in the Australian energy sector since its founding in 2009. Unfortunately, I do not have access to the text that was supposed to be provided. However, I can still provide a general overview essay on what could cause a stock price to increase. The stock price of Tamboran Resources Corp has increased in the past year due to several factors. One key reason is the growing demand for natural gas and oil globally. As economies continue to recover from the pandemic, energy consumption has surged, leading to higher prices for these commodities. Companies like Tamboran Resources Corp that are involved in extracting and producing these resources have seen their stock prices rise as a result. Another factor contributing to the increase in stock price is the company's exploration and development activities. Successful discoveries of new oil and gas reserves can significantly boost a company's valuation, leading to higher stock prices. Additionally, Tamboran Resources Corp may be benefiting from its strategic partnerships with other companies, which can provide access to new markets and technologies. Investor sentiment also plays a crucial role in determining stock prices. If investors become more optimistic about the future prospects of a company, they are likely to buy more shares, driving up the price. This can be due to various factors such as positive earnings reports, innovative products or services, or strong leadership. In the case of Tamboran Resources Corp, it is possible that investors have become more bullish on the company's prospects, leading to an increase in stock price. It is worth noting that other external factors such as changes in government policies, economic trends, and global events can also impact a company's stock price. However, without access to specific information about Tamboran Resources Corp, it is difficult to determine the exact reasons behind its increased stock price. Tamboran Resources Corporation maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Tamboran Resources Corporation trades at a higher price-to-book ratio of 337.23 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 13% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has aggressively reduced its share count despite weak revenue growth. This raises concerns about whether buybacks are being used to offset underlying business challenges. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted, reflecting both internal and external factors. On the growth side, several key events contribute to increased revenue. The Shenandoah South Pilot Project's final investment decision, FID, on September 30, 2025, is a significant milestone, as it marks the beginning of operational activities that will generate revenue. The Falcon acquisition also plays a crucial role in driving revenue growth, with its successful integration and realization of anticipated benefits contributing to increased earnings. In addition to these major events, other factors such as successful drilling results, timely capital funding, negotiation of commercial agreements, access to suitable infrastructure, and the overall performance of the acquired assets further support revenue growth. These elements collectively contribute to a positive outlook for revenue expansion. On the decline side, several challenges pose risks to revenue generation. The company's history of not generating revenues since inception and its expectation of no earnings in the next 12 months sets a bleak backdrop. Potential unknown liabilities and unforeseen increased expenses or delays associated with the Falcon acquisition are significant concerns. Furthermore, loss of joint venture partners and other business partners, as well as termination of existing contracts, can also negatively impact revenue. These factors highlight the importance of careful management and strategic planning to mitigate risks and capitalize on opportunities for growth. By understanding these drivers, stakeholders can better navigate the complex landscape of revenue growth or decline. The net income of the company underwent a significant decline, with a decrease of $29.2 million in one period and a further drop of $1.6 million in another. This indicates a downward trend in the company's profitability over time. While there is no direct mention of a change in profit margins, an analysis of expenses suggests that they may have decreased. The exploration expense, which is likely a significant component of the company's overall costs, showed a reduction of $1 million and then $1.4 million in two separate periods. However, due to the lack of revenue data on page 18, it is not possible to calculate the actual change in profit margins. Nonetheless, the decrease in exploration expenses may indicate that the company has managed to reduce its costs, which could be a contributing factor to the decline in net income. The company's financial performance indicates a lack of positive operating cash flow. The data from the past 2 years shows that the company has been consistently using more cash than it generates from its operations. For the 6 months ended December 31, 2025, the net cash used in operating activities was $14.5 million. This is an increase from the previous year, where the company used $8.9 million in operating cash flow for the same period. These figures suggest that the company's operational expenses are exceeding its revenue generation, resulting in a negative operating cash flow. The persistent use of cash in operating activities indicates that the company may be struggling to manage its costs or generate sufficient revenue from its operations. This could have implications for the company's long-term financial sustainability and ability to invest in growth initiatives. The company's debt level has experienced significant growth. As of December 31, 2025, long-term debt increased by $179.8 million, approximately $133.4 million USD. Furthermore, the company drew down a substantial amount under its syndicated facility in February 2026, totaling $3.3 million for Tranche 1A, $0.7 million for Tranche 1 billion, and $4 million for Tranche 2. In contrast to the rising debt level, interest expenses have remained relatively stable. The company's interest expense on its syndicated facility agreement was constant at $1.7 million for both the 3 months and 6 months ended December 31, 2025. This suggests that despite the increased debt, the company has managed to maintain consistent interest payments. Management's outlook for the company is cautious, with a focus on securing additional capital to fund ongoing exploration and development projects. The company's ability to continue as a going concern depends on obtaining necessary funds, which may not be available on acceptable terms or at all. Revenue generation is expected in the second half of 2026, but until then, the company will incur substantial expenses and generate significant operating losses. To progress development plans, management estimates that $45.5 million will be needed for the remainder of the fiscal year ending June 30, 2026. The company's strategy is to focus on supplying gas into Australia's East Coast domestic gas market, with various financing options being explored, including private and public equity placements, debt funding, and asset sales. Overall, management's message is one of caution and uncertainty, highlighting the need for additional capital to support ongoing development projects. The acquisitions and divestitures made by the company are significant milestones that have shaped its current portfolio. In terms of acquisitions, the company has made several notable moves. One of the most recent acquisitions was the purchase of a 77.5% share of Beetaloo Basin assets from T-Bone on November 9, 2022. This acquisition is expected to bring in new revenue streams and expand the company's presence in the region. Another significant acquisition was made by Tamboran Beatwo Thai Limited, which agreed to acquire FOGA's interest in the wells drilled from the S. Estwo well pad on March 21, 2024. This move demonstrates the company's commitment to expanding its operations and increasing its stake in key assets. The Falcon acquisition is another notable example of the company's acquisition strategy. While details are scarce, it is clear that this deal has had a significant impact on the company's portfolio. On the other hand, the company has also made several divestitures as part of its strategic review. One of the most notable examples is the sale of Falcon's 98.1% interest in FOGA to Tamboran. This move marks a significant shift in the company's ownership structure and is expected to have long-term implications for its operations. The company's financial history reveals a commitment to shareholder value. One notable aspect of this commitment is its practice of paying dividends. This decision demonstrates the company's confidence in its financial stability and ability to distribute profits to its shareholders. By doing so, the company acknowledges the importance of rewarding investors for their loyalty and trust. In addition to paying dividends, the company has also taken steps to further enhance shareholder value through other means. However, the specific details regarding these efforts are not provided in this summary. Nonetheless, it is clear that the company's focus on dividend payments serves as a testament to its dedication to its shareholders' interests. That concludes the financial summary for Tamboran Resources Corporation. Feel free to comment below, and I will be happy to answer them when possible.